How's it going, everyone? Welcome back to another dividend investing video. Generating passive income from dividend stocks is what we are all about here, and we especially love growing dividends. Let's face it, if you didn't get a raise this year thanks to inflation, you got a pay cut. As a long-term dividend growth investor, I try to find companies that grow their dividend at double-digit rates. Because even if you did get, say, a cost of living raise, it likely wasn't 15% or even 10%, at least not for most of us. And with inflation getting worse, this becomes even more critical. So today I'm going to highlight 3 dividend growth stocks that just announced a dividend hike at 10% or more. And I think these are really high quality companies to consider adding to your watch list. So let's get to it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. With double-digit dividend growth, we're prioritizing the rate of growth in the dividend over the dividend's yield. One thing you will see with a lot of stocks with a higher dividend growth rate is you'll be sacrificing some current yield. In my portfolios, I try to find the nice balance of yield and dividend growth, something I think you see in the very popular ETF SCHD. Now, I want to stress, I'm not suggesting you go out and buy these stocks, but I am going to provide some information on them, and you can add these to your watch list. I always recommend doing some further research beyond YouTube videos. Speaking of research, I have partnered with the popular website SeekingAlpha, and during the month of February, they're providing my viewers with an introductory premium membership for only $99 for your first year. This is a 60% discount and comes out to just over $8.25 per day. It's one way you could support my work here on the channel too. Just check out the link in the description. The offer is only made available through that link. Thanks! And stick around until the end. I'm going to go over a few more dividend stocks that just announced raises. There were quite a few this week, and I'm going to try to cover as many as I can. Let me know down in the comments, what dividend stocks are you buying this week? So the first company on our list is Analog Devices, ticker ADI. ADI announced its 20th consecutive dividend raise on February 14th, 2023. Giving shareholders a 13% raise. Analog Devices is a semiconductor company that specializes in data conversion, signal processing, and power management technology. They're headquartered in Massachusetts, but have design centers all around the globe. They have over 125,000 customers in industries such as communications, instrumentation, aerospace and defense, automotives, and consumer electronics applications. Semiconductor companies make for some of my favorite investments, but how does ADI stack up? In the last year, shares of ADI are up 20%, and they've really run up in the last couple months. Year to date, they're up 18%, so most of that gain in the last 12 months was made here in 2023. Zooming out to their 10-year total return and comparing versus the S&P 500, we can see that ADI shares have outperformed the S&P 500 by nearly double. You'd have made more than 4 times your money back in your ADI investment 10 years ago. I like to compare investments against the S&P 500 because beating the market consistently is not an easy thing to do, which is why I also buy a lot of S&P 500 index funds. But the best companies will beat them. Now let's look at ADI in terms of valuation. ADI is trading at a forward PE of 18.5. This is near a 15% discount to its 5-year average of 21.1. It's also about 13% lower than the information technology sector median of 20.1. So shares of ADI look pretty decent from these metrics. Let's look at their dividend. They also gave that sweet raise. Shares are now yielding 1.79%. This is about 7% below its 5-year norm of 1.92. So if I was to be considering a position here, I'm pretty good on semiconductors, but I'd like to see this yield be over its average. Maybe in the 2.1% area would be a decent entry point. This dividend is easily covered by 33% of forward earnings and 42% of free cash flow. Their dividend is $3.44 per share annually, while free cash flow is $7.27 annually. Simply Safe Dividends gives us a safety score of 63 cents, which is a low safe score. Notice the beta is on the high side at 1.26. This means it's going to be more volatile than the broader market. So these kind of stocks, usually you want a better margin of safety. Now the dividend is paid out in the months of March, June, September, and December in the amount of 86 cents per share each quarter for a total annual payout of $3.44. You need to have your shares by February 24th to get that next dividend payment on March 8th. In terms of dividend growth, like many semiconductor companies, ADI is looking quite stellar. With the latest raise, we have 20 years of consecutive dividend growth, growing at double-digit rates over the last 5 and 10-year periods. Moving along to their shares outstanding, I don't like all this dilution, but perhaps this is being driven by some acquisitions. We had 314 million shares outstanding in 2013, and today they are 523 million. The revenue growth, though, has been very strong in this company. They went from bringing in a few billion in revenue 10 years ago. In the last 12 months, they made 12.6 billion. Wall Street analysts rate the stock a buy, 4.19 out of 5. Covered by 21 analysts, 16 rated a strong buy, 5 a buy, and 10 a hold. The average price target is $215.63. Which represents about 12% upside from where it stands today. So ADI looks good. I think this is one of those more under-the-radar picks. Doesn't quite get the attention of the Broadcoms or the Texas Instruments in that sector. But perhaps this could be a go-in to add to your watch list if you're a dividend growth investor looking to increase your exposure to semiconductors. Moving along. All right, the second company we're going to cover is CSX Corporation, ticker CSX. On February 15th, 2023, CSX Corporation announced it was raising its dividend by 10%, marking its 19th consecutive year of raising its quarterly dividend. CSX is a supplier of rail-based freight transportation in North America, with a transportation network covering 23 states plus Ontario and Quebec. They service nearly 2/3 of the American population. Railways today are still one of the most efficient ways to move significant amounts of cargo, and really just a handful of companies control these railways across North America, giving them wide moats. So far year to date, shares of CSX are up about 1%. Over the last year, shares are down about 11%. Let's compare its long-term performance against the S&P 500. If you had purchased shares of CSX 10 years ago, today you'd have a total return of about 388%, while investing in the S&P 500 over the last 10 years would have brought a total return of 225%. So here's another company that has been beating the market. And when I say total return, this includes price return plus dividends paid. Total return. Now today, shares of CSX are trading at a 16.8 PE. This is around an 8% discount to its 5-year average. It's also a few percentage points lower than the industrial sector as a whole at 17.9. Shares are yielding 1.41% right now. While not a high yield, it is 11% above its 5-year average yield of 1.27%. So for investors not needing current income and looking to get into a solid dividend growth stock in the industrial sector, railway, this could be one to take note of. We have $1.63 of free cash flow per share, and the dividend is only 44 cents per year. So this is looking like a very safe covered dividend, taking up only 24% of forward earnings and free cash flow, and a Simply Safe dividend safety score of 85. Very safe. The dividend is paid out quarterly in the months of March, June, September, and December in the amount of 11 cents per share. And if you want the next dividend payment on March 15th, you'll need to have your shares by February 27th. This makes for 19 years of dividend growth, and it's grown at a rate of 16% over that time frame. And this latest announcement at 10%, we are still getting double-digit increases. Now, looking at shares outstanding, this is exactly the trend we want to see. More shares being taken off the market every single year. There were over 3 billion shares outstanding 10 years ago, and today there are 2.14 billion shares. CSX is covered by 29 Wall Street analysts who give it an overall rating of 3.89 out of 5, rating it a buy. 11 have rated it a strong buy, 6 a buy, 11 a hold, and 1 a strong sell. The average analyst price target is $34.16, which would give it about 9.5% upside from where it stands today. CSX is looking quite interesting. I'm an investor in the very similar Union Pacific, who are one of my larger positions overall. And if I was to add a second railroad into the mix, I think CSX checks off a lot of the boxes I'm looking for. I love owning the railroads. When I play Monopoly, I always try to own them all. It's a good strategy in that game, right? And perhaps not a bad strategy for dividend investors. Now, there was that unfortunate incident in Ohio recently with competitor Norfolk Southern. So keep in mind there could be some short-term issues with these companies, but these often create the best opportunities. All right, the third company we're looking at is NextEra Energy, ticker NEE. On February 17th, 2023, the board of directors of NextEra Energy announced their next dividend payment was going to be 10% higher than their last. This is a company that is targeting 10% dividend growth through 2024. A company with goals like this are exactly what I'm looking for in an investment. In full disclosure, I am a shareholder. NextEra Energy is an American energy company, the largest electric utility holding company by market cap. Through their subsidiaries, they provide power to much of Florida. Shares of NextEra Energy are down over 9% year to date, so they've been on a downtrend. Over the last year, shares are practically flat. Zooming out, we got another one that beats the market, and this is a utility. Over the last 10 years, NEE has a total return of 445%, which beats the S&P 500's 225% total return in that same time span. NextEra, from a valuation standpoint, is trading at a PE of 24.5. This is 12.5% lower than its 5-year average, so about as cheap as it's been in a few years. It trades at a premium to the overall utility sector at 18.3. NextEra Energy can be gotten for a 2.46% yield right now, and this is 14% above its 5-year average. NextEra looks attractively valued by that metric. The dividend is covered by 55% of forward earnings. This is quite low for the sector. We expect dividends to take up a large portion of a utilities company's earnings. Now, SimpliSafe Dividends gives NextEra the strongest safety score they have at 99. Their qualified dividend is paid out quarterly in the months of March, June, September, and December in the amount of 46.75 cents per share for a total annual payout of $1.87 per share. The latest dividend raise is the 28th consecutive year NextEra has raised its dividend payment, and that comes at an average annual growth rate of 12% per year over the last 5 years. Utility companies will typically issue shares to fund a portion of their growth expenditures. Buybacks are uncommon in the sector, something you just accept when you invest in utilities. Wall Street analysts rate the stock a buy with an overall rating of 4.16, 7 rated a strong buy, 7 rated a buy, and 4 a hold. The average analyst price target is $93.72, more than 23% upside from where it sits today. I'll be continuing adding to NextEra Energy this year. It's one of the finest utilities to own for dividend growth investors, in my humble opinion. So that is 3 companies with double-digit dividend growth who have just announced some raises, and while they're not screaming discounts right now, they all do look kind of reasonably valued here for long-term investors. Just my humble opinion. As promised, I have more dividend raises to bring you, and a few bonus stocks. Okay. The first here is Extra Space Storage. They just announced an 8% raise for their 13th year of dividend growth. A video on the self-storage REIT sector is coming in March, so be sure you are subscribed for that. Next, we have Cisco Systems, ticker CSCO, raising their dividend by 2.6% for their 12th consecutive year of dividend hikes. They are slow, but steady and reliable. They provide products that help keep us connected. Another recent raise is Realty Income, ticker O. This time it's at 2.4%. They raise this dividend every few months, and this is one of the larger jumps. Realty Income has one of the most reliable monthly dividends out there. They are known as the monthly dividend company. Now, Allstate, ticker ALL, they just announced a 4.7% raise for shareholders. And if you're looking to increase your exposure to the property and casualty insurance, I think Allstate has some appeal for dividend growth investors. And finally, we have a dividend king on the list, and it is none other than Coca-Cola. They have announced a 4.5% raise for their 61st consecutive year of dividend hikes. One of the most consistent dividend-paying companies in history. So this has been a good last few weeks here for dividend raises. We've got some more good stuff coming out, so make sure you have that notification bell hit. And we'll be sure to fill you in on dividend raises with a video like this every month. You guys seem to enjoy it. Until next time, keep investing.